Lyft is an interesting ride-sharing company that I've been following for several years now. To start 2025, I rated Lyft stock as a buy, and the stock price is up almost 20% year to date. And so I'm happy about the performance of Lyft, outperforming the S&P, the Nasdaq index, and delivering excellent returns for viewers that followed that recommendation. So I'm happy with Lyft stock. But investors are asking me to provide an update with this recommendation because I haven't visited and I haven't made a video on Lyft in several months now, so investors are curious how I feel about this investment today. So I will update you. I'll review the company's latest quarterly results, what it can mean for investors. I'll share with you my proprietary discounted cash flow valuation for Lyft, which I updated this morning, and let you know if I think this stock is still a buy or if there's something else that needs to be done with this investment. So Lyft has been making partnerships, including with Baidu and United Airlines. It's also partnering with companies to deliver driverless car technology. And I've been talking about driverless car technology as one of the biggest risks for companies like Lyft and Uber, which, by the way, I've rated Uber as the best stock to buy this year. And I made that recommendation in early January, and Uber shares have performed really, really well in 2025. I own Uber stock, so I'm very happy about the performance of Uber and the performance of Lyft. And my wager or my differentiation here with the driverless car technology is that the risks are overblown. And I'll talk a little more about that as we progress in this video. So the second quarter was another strong execution with all-time highs for rides, gross bookings, and cash flow. In the second quarter, the company reported gross bookings of 4.5 billion, which is up by 12%, a little bit less than Uber's most recent quarter performance. Revenue of 1.6 billion was up 11% year over year. Again, a little bit less than Uber's revenue growth performance. Adjusted EBITDA margin as a percentage of gross booking increased to 2.9%, up from 2.6%, and cash flow from operations jumped to 344 million compared to 276 million. On revenue, if you divide the cash flow from operations to revenue, they have a nearly 25% CFO to sales ratio, and that ratio is improving. And I've talked about that as one of the reasons why I like these rideshare companies. They don't require a lot of capital invested in the company, and so it generates strong cash flow. Click the link below to watch the full video.